They also allude to it on page 142 of the text as a great place to shop and compare the savings rates, whether it's a savings account, money market deposit account, certificate of deposit. Okay. Now, notice one of the advantages on these three types of accounts that are listed is a safe. Right? It's a safe. It's a safe. Right? Then it says federally insured. What does that mean? I mean, a bank is a private company, right? We talked about J.P. Morgan Chase, and we talked about Citibank and Bank of America, and we said they're on the stock exchange. So, government companies aren't on the stock exchange. Private companies are on the stock exchange. You and I can own it. It's not we're not governments, right? We're people, right? So we can own it. Then these are private companies, and private companies can go broke, right? As a matter of fact, in 2008, many of the banks nearly did go broke, right? You hear about the big bailout, right? The government gave a bailout to the banks, So certainly that is a possibility. So what makes it so gosh darn safe, you ask? Oh, okay. Well, let's talk about that. Flip over to page 148, okay? And they talk about safety. Yes, they do. And underneath safety, they talk about Federal Deposit Insurance. Yes, okay. And this was a creation of the Great Depression back in the 30s. I think you remember that very well. And back in the 30s, the banks didn't have any safety net from the government, any insurance from the government, and they failed, right? And we hear what we call run on the banks. People actually running to the banks, basically, to get their money out of the banks before they went broke and they couldn't repay the debt. Because remember, the bank is borrowing the money from you. They couldn't repay the debt, and they declared bankruptcy. Okay, so in order to shore up the banking system, restore confidence in the banking system, the FDIC was created. Federal Deposit Insurance Corporation was created, and this gives those banks, okay, who are members, okay, and by members I mean who pay the insurance premiums because they're an insurance policy, pay the premiums of insurance. They give them the ability of bailing out the depositors who might put their money in with the bank, okay? And as you can see on that page, there is a limit, okay? Each individual depositor is insured for up to $250,000 per depositor at each financial institution. $250,000 per depositor at each financial institution. Hey, for you credit union fans out there, say, wait a minute, David, you just said I should own my money at the credit union's not a bank. There's no Federal Deposit Insurance Corporation for credit unions, is there? Well, you're right, there aren't. But by the same token, if you keep reading on, you'll see that there's another federal government insurance program called the NCUA, the National Credit Union Association, okay, which works in the same fashion for credit unions. Okay. So certainly you have that situation, okay? So $250,000 per depositor, per institution, okay? Basically is the way that it's set up, the Federal Deposit Insurance, okay? Certainly there are ways that you can sort of manipulate the situation to get a lot more than $250,000 of insurance at one institution by holding different types of account titles. Okay, I'll just show you very quickly how a husband and wife, or husband and husband, or wife and wife, right, can basically insure a lot more than just $250,000 in one bank, just by opening up one account purely in the husband's name, for $250,000, another account purely in the wife's name for $250,000, okay, then a third account, which is called a joint account, which they own this account together as a marital unit, okay? And in that account, you could get up to another $500,000 of insurance, okay? Because there are two owners of that one account, okay? So now you're up to $1 million of insurance in one bank, right? $250,000 in the husband's name, $250,000 in the wife's name, and then a $500,000 joint account, okay? So there's $1 million of insurance in one bank without having to put $250 in one bank, $250 in one bank, another bank, having to do it in 4 different banks. You can get that $1 million of insurance in just the one bank simply by doing that. Obviously, when you have things like trust accounts, we'll talk about later on in the course, and the like. You're going to be able to do a lot more than just $1 million with two people. So it's a pretty sweet deal getting all of that insurance, and that's why people have a very, very high certitude that their money will be safe, that they will not have to worry about the bank going under, because the United States, or at least a federal government agency, okay, will step in and pay off the depositors for the money that the bank is unable to pay. Okay, so that's why they've got a very high level of certainty when it comes to the banks and the credit unions, for that matter. Okay. The next item of savings we're going to take a look at is something called money market mutual funds. It's over the bottom of page 142, top of page 143. And the money market mutual funds basically sounds a lot like the money market deposit accounts, right? We talked about with banks. And of course, the answer is that they are not the same thing as a money market deposit account. Because in a money market mutual fund, okay, you are not giving your money to a bank, you're giving your money to another type of financial institution. It's called a mutual fund. Okay, mutual fund. So now you're investing with a private investment company. Okay, when you're talking about a mutual fund. The two most popular investment companies, and we have a whole chapter on stock mutual funds and bond mutual funds. That's coming up in the second half of the course. But now you're going to be investing in the two most two dominant mutual fund families. It's Fidelity and Vanguard. Okay, and you're actually investing with these private institutions in a money market mutual fund. Okay, the nice thing about that, again, they tell you about the advantages. Relatively high interest rates, not really. I mean, they're about the same as the money market deposit accounts. You know, maybe you'll get a quarter of 1%, maybe a half of 1%, but nothing to write home about. They will give you a check writing privilege. They give you the ability to write checks on the companies to do that. But really, what you're doing with a money market mutual fund is generally you want to invest possibly in other types of investments, stock investments, bond investments, and when you're between investments, okay, you can park your money in the money market mutual fund. Okay, now you know one of the advantages not listed on page 140.